Someone asked me earlier at a conference what my job is, what do I do? Which I think is very relevant that I answer today in the context of what I'm about to present to you. There are many reasons to love my job. I'm involved in practically everything to do with hotels, but the core focus is probably on the sale and acquisition of hotel properties and advising our clients to maximize returns. Through the trust that we're given, we get a lot of intelligence that I want to share with you today. I don't have much time, so I'll talk mostly about the investment activity in the region over the past 20 plus years. I'll look at the past 24 months and the trends. I'll talk about the performance and the effect it has, about the yields, and finally, who's actually buying today. By the way, all of it is in the context of only CEE 6 countries: the Czech, Poland, Hungary, Slovakia, Romania, and Bulgaria. So I'm not covering as many countries as Thomas just did in STR. So look at the past 2004 to 2014. What you see is essentially roughly 400 million per annum invested in CEE 6 countries, which is probably very low considering the economies all put together. When I joined in 2015, I was basically hearing emerging markets, developing markets. So you would present someone an opportunity of 7, 8%, and people would look at you, are you crazy? Like 7, 8%? That was back in 2015, when the market just started picking up. And that was essentially what happened between 2015 and 2019. The perception of those risky countries, the perception of emerging markets, slowly faded away. And you all of a sudden started seeing a lot more liquidity, a lot more investors, nationality of investors, who were probably struggling finding deals in the West, or they were, but they started looking at better returns, which were present in the East. So that went from 2015 to 2019 to 800 million per annum on average, with 19 hitting 1.5 billion. And everyone was sort of expecting, 19 was overheated. We're talking about over-tourism. Everyone was already being a bit scary, like, is it going to be sort of the peak, which I guess they were right, but for different reasons, right? We all took a big step back to 400 million on average, and that's where we are now. I mean, there's a lot more activity happening in 23 than there was in 22. I am fairly confident CEE 6 have the muscle memory to go back to the 19 levels much faster than 10, 15 years. We're now facing totally different short-term challenges. I want to believe that they are short-term challenges, but they are there. And I'll touch upon some, but we all know what they are: high cost of borrowing, the geopolitical situation. And I think this is what is pausing that activity, not the perception of Eastern markets. Nobody's talking about Prague or Budapest or Warsaw as emerging markets. Everyone has sort of got that confidence that these markets will bounce back. I mean, there's plenty of liquidity. There have been deals done over 200 million in size per asset. So I mean, I think we have a very good medium-term future ahead of us, maybe short-term. I don't want to be too optimistic. So yeah, talking about maybe the past 24 months, and you see actually there is a pretty big sort of forecasted number to achieve the 2023. That is mainly because there are a couple of deals that have signed in September, and there are a couple of deals that are in exclusivity. So I think we'll, worst case scenario, probably just reach more or less the same level as 22. 24 months. You compare 21, 22 versus 22, 23 the same year, and you basically see that more or less same amount of properties traded, but the volumes have significantly went up. There are a couple of reasons for that, maybe two reasons. One is there are a lot of smaller properties that were traded in 22 in the regional cities of the countries, versus now, the past 12 months, there have been a lot of interest in upper upscale luxury properties. Another reason is you probably all know that CPI has snapped SIMO, and as part of that, let's say, takeover, they inherited a lot of big, large, sexy hotels in a way, like the likes of Marriott in Budapest, or the Ramada here in the Wenzel Square. So those numbers do include, let's say, that takeover, which obviously is not an on-market process, but does help inflate those numbers. What you see on the right-hand side, and I think one of the countries that I've heard already, STR touching upon and Kiwi touching upon is Poland. I think, first of all, Poland deserves to be up there. I mean, the economy is huge, the scale is there. I mean, it's a lot more developed in terms of fragmentation of smaller markets versus, let's say, Czech Republic or Hungary. And we signed a deal in September, which is not reflected here, but it's under 100 million, which once it's closed in October, those numbers will be already in top 2. So I think Poland will definitely be out there in top positions in the years to come in terms of investment. I think it did not reach that maturity in 19, which maybe Czech Republic did it in terms of its liquidity and investors coming in. So there's a lot more growth for a market like Poland in the years to come when it comes to hotel transactions. Now, there's a lot of interesting facts on that one. Who's buying? There are 2 main trends, and I think one of them is very visible. It's a lot of private wealth. We completed 4 transactions so far in the region, and 1 signed and a couple in exclusivity. All of them are going to private wealth. So those are very large family offices who haven't really bought hotels before and then now expanding and made their money in either retail or production or anything else, frankly. And now they're expanding in hotels. So, and they don't, frankly, they don't really care what the risks are. Yeah, they have their own drivers, they have their own beliefs. They can live with 5% return today. Yeah, they are, let's say, unorthodox buyers that are driven by totally different, let's say, reasons, motivations behind. And the second trend is essentially the large groups who have historically been big investors in other asset classes like offices, retail, or industrial, are now inviting us to pitch to them on this sector. Not necessarily pitch to them some opportunities, but on the sector. They want to reinvest more or invest more. They have reallocated some portion. A lot of them are looking at leisure destinations. So not so much business hotels, but generally hospitality and specifically leisure. For the same reasons we all mention about hospitality being very hard to replicate, right? Those senses of an ocean, whatever, people will want to spend on experiences. And there's huge long-term fundamentals and growth for that. So, private wealth, large funds in the region looking at diversifying in hotels. 86% for the past 12 months who bought were basically domestic capital. You know, the funds that were out there, institutional funds, a lot of French funds, German funds, are simply sort of, I mean, some of them look at it, but they struggle to compete pricing-wise now with private wealth, which was the opposite in 2019, right? So that's, to me, is probably what's going to stay as a trend in the next 12 months. It's hard to see a lot of institutionals or overseas investors coming back in the current market environment, even though it's better than it was last year. So to talk about the top 6 in CE6, it's more of a, let's say, fun slide. I mean, there's nothing too crazy about it. I think if I was just to talk about the past 12 months, you would only see 2 investors on that same slide. That's CPI, who, because of that takeover of Asimo, and that's BDPST, probably, or maybe without probably, the most dominant investor in Hungary, or in Hungarian hotel market. Covivio, a French fund, they snapped a couple of properties back in 20s. What you used to know as many names, Boscolo, Dedicantology, a portfolio plus a couple of deals in Poland. R2G, they've done 1 deal, but they probably have a record in things. It's the largest single asset transaction ever. It's the former Intercon, which is now going to be Fairmont. Probably one of the most awaited openings in 24, which is a very large asset being reshaped into a microenvironment. It's Venasgruppen, the Norwegian fund or family office fund who bought Radisson Blu and Don Giovanni back in 1920 as well. And it's Union Investment, the German fund who bought a couple of hotels in Poland. But as I said, today you would only see 2 investors and probably a bunch of other names that you don't recognize. So what about the performance? Obviously, I'm not going to take such a deep dive in the numbers of the markets, but I think there are a couple of short-term challenges which I've just touched upon, right? The geopolitical situation, which God knows when it's going to be resolved or better, and then the high cost of borrowing. You have misalignment and expectation of pricing, which I think is always sort of there, but probably more than ever here today. And these are the things that basically, let's say, pause or slow down the investment activity. And only the people based here, knowing the market, not fearing the market, can do the deals, right? But these are, hopefully, as I said, short-term challenges, or maybe 3 to 5 year challenges. Once they're gone, the performance is actually what shows everyone and shows the investors that strong confidence in hotels as a sector. And they have rebounded much faster than everyone was thinking. Just think where we were 18 months ago. I mean, thinking about that growth, which is happening in CEE today. I mean, the graph that Thomas was just showing, I remember the yellow line, whatever. I mean, 2023, it's by far more than anyone expected. So the ADRs are holding up, which is something that hasn't been there in 8-9 crisis. And that gives a lot of, let's say, confidence to investors, or that will give a lot of confidence to investors once these challenges are gone. Probably the last thing I want to talk about is the yields. So just to give some practical examples, what traded, and let's take lease as an example. It's a lot harder with variable income because of all the storyline that it has. But what traded at 5% in Prague in 2019 is trading at 6 to 6.5% in Prague today. So 100 to 150 bips, readjustment. What traded at 5.5 in Warsaw in 19 is trading at 7 or sub 7 in Warsaw today. So people who want to sell today have to clearly accept the fact that investors are expecting some readjustment on 219. Now there's a bit of a different story when it comes to variable income, so management contracts unencumbered by brand properties or franchise contracts, because these are the properties that you can talk about that huge upside potential, repositioning, investments, capex, that can drive the ADRs, etc. So here, sometimes you would see initial yields at 3%, but they don't mean much. You need to look at really what can be done tomorrow, what can be done the day after. Not everyone is willing to pay for that. Not everyone wants to pay for upfront work to be done, but you always find one or two who believe it and who believe they can execute and do even better than you think. So all in all, yields are obviously decompressing because of all the factors I've mentioned, because of all the challenges. How long? No clue, to be frank. But I do believe that it's okay that they're at this level today, or perhaps we'll readjust slightly more. You always will find someone interested in your product if you have a storyline. And all I'm left with is to thank you for your attention. Thank you very much.